Chim chimney chim chim chiree, y'all. Despite median sales prices having gone down over the last month in Miami-Dade, a less expensive home is actually going to cost you more now because interest rates have recently gone up, and we're going to talk about it and what it means. Jake Fletcher here with the Fletcher Group at eXp Realty, right here in Miami, Florida, your Miami real estate agent. And if you guys appreciate videos like this, do me a quick little favor. Go ahead and smash the like button, hit subscribe, ring the notification bell, do a double backflip McTwisty off the high dive, and share this video with anybody that you know who might be interested in checking it out. So, in this video, we're going to be looking at conventional and FHA loans over the last month and the last year to basically see what the difference in your monthly payments would be when we adjust for the different interest rates at those different times, as well as the different median sales prices at those different times. So this is going to give you a very solid understanding of how interest rates affect home affordability. I know.
Very sexy topic.
So try to contain yourselves. And we're going to talk about at the end whether you should buy now, wait for lower rates, or what you should do if you're potentially in the market to consider purchasing a home. So without any further ado, let's drop on into the video. All right, so the 30-year fixed rate conventional loan averages as of right now are at 5.81% as of Thursday, August 25th, which is up 0.76% since August 1st, 2022. So since the beginning of this month, not even a full month, interest rates are up 76 basis points, okay, 0.76%. We also know that median sale prices for all property types in Miami-Dade as of right now is $465,000, which is actually down $5,000 from a month ago, or about 1% when they were $470,000. And that 5.81% interest rate for conventional 30-year fixed rate mortgages is also up 2.83% year over year, meaning same time last year, interest rates were at 2.98% or 2.83% less than they are today. And at that same point in time a year ago, median sales prices were $405,000 for all property types, so $60,000 less than today. Prices are up 14.8% from a year ago for all property types combined. So we're going to take a look at, first and foremost, our 30-year fixed rate conventional mortgage graph. So you can see right here, and there's a few different things. You got the Freddie Mac figure, Mortgage Bankers of America, and the Mortgage News Daily, which is where I'm getting this graph from, mortgagenewsdaily.com. And what we can see here is that's where that 5.81% figure is coming from. Over here was your August 1st. That was your 5.05, okay? And then, a year ago is not on the graph, but that's when they were like way over here in that 2.98 range, okay? So I guess it would have been like right there. Anyways, so what we're going to look at next here is if you're on a tablet or a phone, I apologize in advance because you probably won't be able to read this. I'll zoom it in a little bit, so hopefully you can see a little better. But basically, we're taking a purchase today at today's median sale price. So your payment right now for a median sale price property of $465,000 would be $3,570 a month at 5.81% interest, okay? So just 1 month ago, for an even more expensive home by $5,000, median sale price, a property that is $470,000, your monthly payment, as we're gonna see on the next graph here, would be $3,388 at 5.05% interest, which is a difference of $182 per month in only 1 month's time, okay? So before we go any further, a couple assumptions here. What we're leaving the same for all these examples is property tax. I just put $6,000. Your private mortgage insurance for conventional loans is going to be about 0.5%. I put $3,500 for home insurance. So, and 5% down payment as well. These figures could fluctuate, but we're keeping them all the same for the sake of this illustration. So your payment a year ago using this same median sale priced home, which a year ago would have cost $405,000, and you would have been able to purchase it on average with a 2.98% interest rate, would only be, drum roll please, $2,570, a difference of exactly $1,000 in just 1 year for the same property, okay? So for that same exact property, you've gone up $1,000 in your monthly payment when all the other variables are the same, right? That's not even considering the fact that, a more expensive property is gonna have a higher property tax rate, et cetera, right? So, that's pretty substantial, I would say. So let's talk about FHA. So here's our graph for the 30-year fixed rate FHA loan. And you can see that the averages as of today are 5.25% as of Thursday, August 25th, which is up 0.7% since August 1st, the same year. So less than a month, and those interest rates have gone up 70 basis points. Again, median sale price for all property types in Miami-Dade right now is $465,000. So that 5.25% interest rate, which is also up 2.5% year over year, when the average interest rates for the 30-year fixed rate FHA loan was 2.75, and median sales prices, again, was $405. So let's look at our payment examples here. So your payment example for right now, FHA, $465,000 median sale price with an FHA loan would be $3,587 per month, right? We can see that there. And that would be at today's rate of 5.25% interest. Just one single month ago, for the more expensive, $5,000 more expensive, $470,000 median sale price property, your monthly payment would be $3,424 at 4.55% interest. So that's a difference of $163 in only 1 month's time, okay? So pretty similar, a little bit less of a difference than the conventional, but still, in only 1 month, $163 more for your monthly payment for the same property, right? Just different interest rate and even different sale price that's even lower. So your payment, this is our 1 year example here coming up, and your payment for that, the median sale price property, which would be $405,000 with 2.75% interest, would be only $2,664, a difference of exactly $923 in just 1 year for the same property. All right, so let's talk about this. What's going on? What does all this mean? What's happening? So the Fed has raised rates recently with fears of a recession reducing slightly as of late, right? I talked about this in previous videos. CPI was a meet, PPI was, we beat PPI, fuel is going down, et cetera, right? So with future data, of course, things could potentially change. So if a recession becomes more likely, we could actually see rates drop back down. But if we see inflation continuing to rise, then we could see rates continue to spike. So what do you do? So first of all, you have to figure out where you stand. What do you think is likely? Because I don't have a crystal ball. Nobody has a crystal ball. So you have to figure out for yourself, where do you stand? What do you think is most likely? Do you think a recession is likely? Do you think that we're already in a recession, perhaps? Maybe you think that we're in one, but it's only a slight recession. Or maybe you think that there's no recession coming, or maybe you think that it's already here. So next you have to decide, what do you think is going to happen with inflation? Because watching inflation is a huge indicator of what will happen with mortgage rates. So will inflation rise or continue to fall, or mostly stay the same? That's up for you to decide. I can't tell you what's going to happen. Here are a few examples, though, to illustrate what I mean. So if you think that there will be no recession and that inflation will go up, expect higher rates to dampen the economy. If you think that there is or will be a recession or inflation will continue reducing, then we may see lower rates to help stimulate markets. If you think that there is or will be a recession and inflation will go up, then we could see higher rates depending on what happens with unemployment and how bad that recession might get. If you think that there is or will be a recession, but inflation will continue going down, then we could see lower rates, again, depending on what happens with unemployment and just how bad the recession gets, okay? So also, always remember the rule of 10%, which in general states that for every 1% that interest rates go up, prices tend to go down 10% because buyers have lost purchasing power, and vice versa. If rates go down 1%, prices tend to go up 10% because buyers have gained purchasing power. So if we continue to see interest rates rise, that could create enough downward pressure on prices to actually potentially substantially move them down or moderately move them down. And depending on how much purchasing power buyers lose is what's going to kind of determine where those prices go. Because ultimately, the market is going to decide how much it's going to pay for something. And we are the market. Buyers are the market, right? So if rates go back down, then that could actually make rising home prices all the more likely, okay? So this is all just to give you an idea, because obviously the intricacies of monetary policy, Fed decision-making, macro and microeconomic factors is too much to put into one YouTube video, but at least now you can kind of get an idea of what we can potentially expect. And in the meantime, if you enjoyed this video, make sure to inflate that like button, hit subscribe, ring the bell, and share this video with anybody that you think might find it useful. And until the next video, hope you guys stay well, take care, and keep on winning. Peace.